Hi everyone, let's take a look at problem 14-8A where we're dealing with some installment notes. Okay, now I'm reading this section right in here. Okay, on November 1st, 2007, Norwood borrows $200,000 cash from a bank by signing a 5-year installment note bearing 8% interest. The note requires equal total payments each year on October 31st. And requirement 1 says, compute the total amount of the installment payment. And they'd like us to use the present value table, B3. But I'm going to do this using Excel, which is my favorite way to compute what the dollar amount should be. So let's jump to Excel now. Okay, I've staged a little bit of this for us. The principal amount is $200,000. Okay, and I'll actually enter that in dollars so that we can see that. The interest amount given in this problem, they said, was 8%, so we'll enter that. And the number of periods, it's a 5-year installment note. So we'll put 5 here. And then we need to determine what the payment is. Okay, well, now using Excel's finance functions, one of them is the payment, so I can type in equal PMT for payment, hit the left paren, or the left parentheses, and you'll see it'll ask for these parameters. Now once you have that on the screen, you can click right here on the formula editor. It says insert formula, but this is commonly called the formula editor, and we get a little pop-up screen. I'll leave that so you can see that. Well, the rate appears in cell C2. Number of periods appears in cell C3. The present value is the amount of the loan, $200,000. Okay, and the future value will be 0 at the end, so we can leave that off. And we're assuming that the payments are made at the end of the period, so we can leave that empty as well. Or you can make it a 0. I tend to leave it empty. And if I hit enter, I get the amount of the payment. Now, the reason it's negative is because the way Excel works is it assumes money you give up now, or money you get now is a positive, and money you give up later is a negative. So I'm perfectly fine with showing that as a $50,091 payment as a negative, because that's the payments we're going to have to give up in exchange for the $200,000 we're getting now. Okay, so we would drop in whole dollars, 50,091, and that would be the answer to part 1. Now, part 2 says complete an amortization for the table, and they've given us the titles of how it should look. Calculate interest expense in the final period is the amount of cash minus the beginning balance, and don't leave any cells blank. Okay. So let's work this one in Excel as well, because I think it's easy to do that. Okay, now I've moved back over to Excel and I've changed the columns and dropped in the titles just to save time in the demo. And then we can start right in. So I'll just skip a row just to make it look a little clean. And the period ending 10/31/2008. And then we've got to add a year to it. Now, I think I could actually say do that plus 365, and we should be able to get all 5 years. Okay, so that's one way to quickly get to that. The beginning balance is the amount that we're borrowing, right? The interest expense is going to be 8% times that, so we'll take the 200,000 times the 8%, and I'm going to lock that in with an F4, which means always grab from cell C2 even if I copy this. All right, and let me format this as well. I want to do it just in whole dollars. Okay, so if we have payments of $50,091, we can take the payment. Oh, let me round this to a whole dollar now. So what I'm going to do is enter round around that formula, then a comma and a 0, and that will round it to whole dollars. Okay, so once we do that, I can kill the decimal places, and then I can say take the 5091. I'm using a minus sign because it's negative, and subtract $16,000, and that would be the amount of amortization of the $50,000 payment we're going to have each period. $16,000 will go to debit interest expense, right? The amount of cash, of course, is going to be equal to the $50,091, the payment. And so the ending balance then is equal to $200,000 less the amount of the notes payable that we're amortizing. Okay, so $165,909. Then we just carry that forward. Now, if I've done this right, all of this should copy correctly, and I think the only thing I've done wrong is this needs to be locked in. And I should be able to copy this all the way down, then copy this all the way down, and everything should work right. But it doesn't, so I know I've got a couple formulas wrong. Right, that's right. This then needs to be, oh yeah, at this point it's, and now that we're in the second year, we've got to take the beginning. No, I think that's right. We would still take C6 minus C11. Let me fix that. Oh, here's the problem. This needs to be an absolute reference. So if I copy that down, now we look right, and look, we balance to within $2. So let me sort of show you what I did. The debit expense, again, is going to be the interest expense times the beginning balance. Then we subtract out the payment minus how much is interest expense, and that difference represents the amortization of the note. Okay? The payment amount is always the amount we're going to credit cash, and the ending balance works its way down. Now, the only thing we need to do in the last year is recognize that we're $2 off because of rounding. So if we increase this plus $2, we eventually get to 0. Okay? And that takes care of our amortization. And then I think the only other thing they do is they go ahead and they sum the total amount of interest expense. And then we sum the total amount of that we wrote off, which is $200,000. And the total amount of cash this cost us was $250,450. So I think I'll draw just a actually shade this again so that we can see that that's not actually the table, but more of a summary or total data. Okay, and that's the answer to part 2. Now I'm not going to drop it in the other screen because you can see the approach here in Excel, but let's go back and look at the next part of that screen. Okay, now down here on number 3, in this area here, it says prepare the journal entries in which Norwood records the following. Okay, so on December 31st, 2007, they need to record interest expense. And keep in mind, this is only for the annual amount. So sliding back up, you remember that we took it out on November 1st, 2007. So we're only recording, what is that, 2 months worth of interest, I believe? So 2 months worth of interest would be equal to some portion of that initial $16,000. Okay, so I'll just work that here for us. The partial interest expense for 2008 for a calendar year is going to be equal to $16,000 times essentially 2 months, right? So we can take 2/12 to record how much of that needs to be recorded. And it's 2666.67. So if we flick back over here, this is 2667, and we would debit interest expense, and we would credit interest payable. We're not paying it, but we do need to record the liability as well as the interest expense in that first year. And then when we make the first payment, this comes right from our schedule. We already know that the cash amount, I always do the easiest first here. So the cash amount was equal to the payment amount, which was $50,091, right? Then we need to record the full interest expense. Okay, and the interest expense now is the $16,000, but we've already recorded 2667 up here. So we could record 13,333, then get rid of the interest payable that we recorded at the end of the prior year, which is 2667. And again, the amortization of the note was the notes payable for 34,091. And let me flip back and show you where that came from. Okay, there's the 34,091. There's the total 16,000. There's the 50,091. So hopefully you see where all that comes from. That's the first annual payment. And I think that's all there is to this problem. Thanks, everybody.